Hello, David Moore with Equity Advantage, and I've got Robert Smith of Peregrine Private Capital here today. We're talking all things DST, and we want to talk about a little bit about inflation. And the reason I'm sort of going a little quietly there is I've heard that maybe it's happening, but I've heard that it's not happening too, right? I mean, it seems like I hear a lot of news out there that we don't have inflation, and all I know is I'm getting half the gas for what I used to pay.
Twice as much.
Yeah, twice as much. So anyway, why don't we talk a little bit about inflation and what you're, from your perspective, is you're seeing, and then I just sort of like to point out there we've been fighting to keep 1031 intact, and sort of appears, I don't want to say that we're clear at this point in time, but one of the things they'd propose is capping annual deferral of gain at $500,000 per person per year. And I think really if we look at that proposal, it sort of dovetails back to 1997 with the 250 and 500 on the exclusion. I get this sort of awful feeling that that's what they're actually basing it on.
Yeah.
Well, and from that, in that context, you look at what 250 or 500 meant in 1997 versus today. I mean, realistically, what should that 250 and 500 be today? I mean, probably at least $500,000 and $1 million, if not more than that, probably.
I think it should be well, back then we didn't have $20 trillion and counting in debt.
Yes.
Okay, so and I'm not an economist, and I have not crunched the numbers in terms of time value of money, all that good kind of stuff, but I'm guessing it'd be worth at least $2.5 million, because it just, with $6 trillion in stimulus and counting floating down out of the sky from helicopters. I mean, it just, and we're going on, what Jim Grant in his Interest Rate Observer made the point that we are at a 4,000-year low in interest rates, meaning in the entire history of money, interest rates have never been this low. So money has no value, okay? Zero. And they just keep throwing more and more and more of it at you. But at the same time, they're, as you just said, they're working with this predicate from a valuation standpoint that's at least half a lifetime dated. That tells you how unplugged Washington, D.C. and the Beltline is from the reality and us on the street. End of story.
So we've got our sister company, IRA Advantage, and that IRA Advantage provides people the opportunity to take their retirement account, buy things Wall Street does not sell. And one of the primary reasons people come to us is they want tangible assets, inflationary hedges. So typically when we look at tangible assets, they're all considered alternative investments, which drives me crazy. I mean, because typically tangible assets, the oldest investments known to mankind, real estate, gold, silver might come to mind. But you think
real
about
things.
Bart?
Real things.
Yeah, real things, exactly, not alternatives. But if we look at the difference between, let's say, real estate, I like to say real estate's the ultimate tangible asset. If we buy gold or silver, we're betting it's going up, right? And if it doesn't go up, we're not making anything. Where real estate doesn't have to go up to make you money. If you're pulling money out of your pocket, you're going to have some tax benefits that it offers. If you're shoving money into it from your IRA 401k, maybe you don't have those tax benefits, but you're still gaining that benefit of somebody else paying a debt down if it's leveraged or giving you cash flow or whatever it might be. And so you're in the business selling tangible assets. So, I mean, what do you see happening with inflation right now, and what do you see happening with the assets that you're dealing with?
David, we've been banging the inflation drum longer than anyone in the DST space. If you go to our website, peregrineprivatecapital.com, hit the Learn More button, drop down menu blogs, you're going to see 1.5 years worth of commentary about inflation is coming, okay? And now that it's here, the same people that a year and a half...
It is here, people.
It is here. And the same people that were telling you 1.5 years ago that it's not coming are telling you that it's going to be temporary or transitory. They were wrong then, they are wrong now. Because it's government, and government talks out of both sides of its mouth at the same time. They're saying, oh, we really don't have inflation because inflation is hard on retail investors like you and I, where in reality, government wants inflation because they've got $20 trillion in debt, and the only way that can be handled is for it to be inflated away. So, like all administrations, they're telling you one thing while in reality they are doing quite the contrary. So you as an investor, you are leaving a period of historically unprecedented low interest rates and stable pricing and entering into a period, we think, where government is going to actively promote higher prices and inflation so they can inflate away that $20 trillion and counting in debt that they have spent the last decade accumulating. And you as an investor have to prepare yourself for that.
So it's interesting. I mean, if somebody's going to sell a piece of property today, and obviously I'm on the phone every day, all day with people doing that, but if they're they're giving up assets they've had control of, and obviously if they're doing an exchange, it's real property. So we're always talking about the inflationary hedge, but you're looking at the increased property values over the last 6 months, 8 months, 10 months time, and everybody's so happy, and really it doesn't do you any good unless you're gonna sell because you're just paying more in property taxes on the stuff. But in that situation where if you're looking at maybe just selling a property, walking away from real estate because you don't want to deal with the repercussions of rent control or whatever it might be, what are you going to do with the money? I mean, if you're not putting it back into real estate today, that's going to at least somewhat keep pace with inflation. I mean, what are your choices out there? I mean, obviously this is one of the drivers that keeps you busy.
I mean, the choices are pretty obvious, and they're brutal. I mean, you can pay your taxes from which you will likely never recover in terms of principal and invest it in the stock market at an all-time high. Just in time.
Well, and to do that, you're having to pay the tax.
Right.
So you're losing in today's world up to 40%. If the tax reform goes through, you can be up in the mid-50s.
Right. So you're going to give,
So how long does it take you to make back what you just paid in tax to get whole if you do that?
Well, I'm not.
And I'm not asking you. I'm just asking the audience out there.
Yeah, exactly. Yeah. I'm not an actuary, but given the fact that most DST clients are older and they have spent their lifetime accumulating this wealth, I would say they don't have enough time left to re-earn all of that equity that they're going to give to the government by way of taxes. So, and historically, leveraged real estate has been one of the best hedges available against inflation. So actually it gives, what we're looking at now, people that have held these rental properties for 15, 20, 30 years and have no debt on them, it actually gives them an opportunity to take that profit, at or close to some kind of market top, 1031 exchange into a market basket of diversified properties, some of which can have debt. And then you, as an investor, get to play the same game your government's playing, meaning they're going to inflate away all their debt. You can then pay down that debt with significantly devalued dollars. So you're getting the same benefit as an investor that your government's getting. And so that historically has been an excellent inflation hedge.
So what I'd tell people is if they want to diversify and get into Wall Street stuff, I'll probably tell them before they ever put the property in the market, a year or two in advance, do a cash out refi, pull the money, do that. Then when they do get rid of the property, exchange into the DST, they got the passive, they got the real estate, and they didn't have to pay any tax. That's a great plan, right?
Good. Excellent plan. Excellent plan.
Yeah, I just look at it, and it's always amazing because if somebody sells today, number one, my number one concern for somebody selling today, and once again, we're talking right now, it's September of 2021, and we're looking, today's another hearing on tax reform and what they're dealing with these plans. But we don't know today what's going to happen with the tax rates and when they'll be actually effective. And I just want to stress that the initial proposals were retroactive to April 26 of 21, which I think if they actually tried to do, they'd probably be fraught with lawsuits and everything else. I can't see how that happens. Where if there was a change to 1031, it would be effective 1/1/22. So, that's something you can work with. But right now, my concern for the people that are looking at maybe just selling, paying tax is you don't know what the tax is going to be. And once again, what are you going to do with the money? And if you put it in the money, put the money in the bank, you get nothing. If you put it in Wall Street, we're pretty frothy there. So, who knows what that does. And you have to pay the tax, as we just said, to get it there. You've got things like an opportunity zone that's, I look at OZ sort of like a Roth IRA where you've got limited deferral into the thing, and then whatever you make on it, if you make money on it, is going to be tax-free. Now, OZ, you got to understand, it's a development play, and it's only as good as the development. So what good's tax deferral if it doesn't work out, and you've got to go for a long ride there. But otherwise you're just looking at different forms of installment sales, whether they're structured sales, a regular installment sale, the other CRT or the other DST, Deferred Sales Trust, doesn't have an actual approval from the federal government yet. But really, if we're looking at just inflationary hedges, real estate's the ultimate one, and that's something that's driving. You've got to be a busy boy right now.
Yeah, this is the busiest we've ever been. This is the busiest by far that we've been in 21 years, or since the inception of DST when we first started out. And we tell everybody that, market tops always go on much longer than anyone anticipates because bubbles, and all of our markets are very bubblicious now. That's not a rational exercise. That's driven by emotion. And so you're trying to step back and understand something that is fundamentally not rationally. And so they tend to last longer than most reasonable people would anticipate. That being said, at this point in time, with as overpriced as most individual assets are, we tell people the principal strength of DST is the ability to diversify, because of the fractional ownership nature of DST properties. Yeah. If you're going to exchange into DSTs as opposed to do your own deal, it gives you an opportunity to diversify functionally and geographically better than you can possibly do, or most people can possibly do themselves.
And I think we'll hit that up harder in a little bit, but I think that's a critical deal. Diversification gives you stability. Any financial advisor is going to say the best secret to success is, or it's not a very good secret actually, but the recipe for success is diversification. So, all right. David Moore, Equity Advantage, Robert Smith, Peregrine Private Capital, and we'll be right back. Thank you.
Thank you.
I know you didn't read my heart. You didn't even read my story. Good girl, with these scars. I can see me straight right through you. Took out my phone and I felt nervous and confused.